Right now, somewhere in America, someone is signing loan paperwork with a number on it they think their bank invented. A car payment, a mortgage rate, a number that feels personal, like it was calculated just for them, based on their credit score and their job and how nice they were to the loan officer. It wasn't. That number was set days ago by strangers trading paper in a market most people have never seen, worth about $145 trillion, bigger than every stock market on the planet combined, bigger than the GDP of every country on Earth added together twice over. Here's the benchmark that should bother you. The average American has less than $5,000 in savings. Meanwhile, this market moves more than that in the time it takes you to read this sentence, and it does it every single second, all day, every day, forever. You are not too small to be affected by it. You are simply too small to have ever been told it exists. And here's the part that should really bother you. It's not just your mortgage, it's your rent, because your landlord's loan is priced off it too. It's your job, because your employer's ability to borrow, expand, or lay people off is priced off it too. It's your retirement account, the one you were told was the safe half of your portfolio. That market touched it last year, and it lost value like a stock. So here's the sentence to remember. You don't get to opt out of the bond market. You just get to decide whether you understand it before it moves or after. Most people learn how this works the same way they learn how a stove is hot, after. I'd rather you learn it now, for free, before it costs you a mortgage payment, a job, or a decade of retirement savings. So let's open the machine up. Here's how the number that runs your entire financial life actually gets made. A bond is nothing more than an IOU with better branding. Someone needs money, a government, a company, sometimes a city that wants a stadium nobody asked for. Instead of walking into a bank, they walk into this market and borrow directly from investors. You hand over $1,000, they hand you two promises, a fixed payment every year, called a coupon, and your $1,000 back on a set date, called maturity. Here's the mechanism nobody explains, and it's the entire reveal. Say you buy that $1,000 bond paying 2%, $20 a year. Fine. A year later, rates rise, and a brand new bond, same $1,000, now pays 5%, $50 a year. Nobody wants your bond anymore at full price. It still pays exactly what it promised, but it's now priced like a used phone next to a brand new one. The only way to sell it is to drop the price until that fixed $20 payment works out to roughly 5% for whoever buys it. You just watched your safe investment lose value without doing anything wrong at all. That's the whole rule. When rates go up, existing bond prices go down. Tattoo it somewhere, because everything else in this video is that one rule wearing a bigger costume. Now the twist, this didn't stay theoretical. In 2022, the Federal Reserve raised interest rates faster than almost any point in modern history, and by that same rule, bonds got crushed. The broadest bond index in America fell 13% that year, worst year on record since 1976. Long-term Treasury bonds, the ones people call the safest asset on the planet, lost over 39%, not a typo, nearly 40% in an asset your financial advisor called the safe part of your portfolio. Zoom out further, the classic 60-40 retirement portfolio, 60% stocks, 40% bonds, the entire industry standard for playing it safe, lost around 17% that year. For the first time since 1974, the safe half didn't cushion the fall. It piled on top of it. Here's the gut punch. Nobody sat you down and told you that safe doesn't mean stable. It means the government will eventually pay you back. It says nothing about what happens to the value of that promise while you're still holding it. Meet Denise, 58 years old, works as a school administrator, $41,000 a year, 22 years into building a retirement account she was told to stop worrying about the moment she moved most of it into bonds. Her advisor called it the responsible move. Lock in the gains, reduce the risk, coast into retirement. That's what SAFE was supposed to buy her. In January of 2022, her account sat at $310,000. By the end of that year, it had dropped to roughly $257,000. $53,000 gone, on paper, from the conservative half of her portfolio 3 years before she planned to stop working. She didn't do anything wrong. She didn't panic sell, didn't chase a hot stock, didn't gamble on crypto. She did exactly what she was told, and the math did the rest. Here's what a $53,000 hole means in a Tuesday afternoon kind of way. It's 2 more years of work she didn't plan on. It's a retirement date that quietly moved from a real number to a maybe. It's a phone call to her advisor asking a question nobody had a comfortable answer for. Now, the objection you're already forming, but I'm younger than Denise, this doesn't apply to me. Fair, except 40% of near retirees hold significant bond allocations specifically because they were told bonds get safer as retirement approaches, and rate cycles like 2022 don't check your age before they happen. Or maybe you're thinking, but I'm not owning individual bonds, I'm in a fund. This is different. It's actually worse. A fund never matures. It's repriced every single day, which means the loss doesn't sit quietly waiting to resolve itself. It shows up on your statement in real time and stays there as long as rates stay elevated. Denise isn't reckless and she isn't rare. She's the default outcome of an entire industry telling people that duration risk doesn't exist as long as the bond is government issued. The system didn't fail her by lying outright. It failed her by leaving out the one sentence that mattered most. Here's the boring alternative nobody sells because there's no commission in it. Short duration. Instead of locking your money into long-term bonds that swing 39% when rates move, you hold shorter-term treasuries or a simple treasury bill ladder, where your money comes back to you in months instead of decades. Right now, 3-month treasury bills pay around 3.7%. Money market funds sit close behind. Same government backing, same safety, a fraction of the price swing, because the shorter the wait, the less room rates have to hurt you before you get your money back anyway. Run the actual difference. Denise's long-duration bond fund lost 17% in a single year. If that same $53,000 had simply sat in short-term treasuries instead, she'd have lost close to nothing and picked up a steady 3 to 4% along the way. Run that gap forward. A 1% difference in return compounded over 20 years on a $300,000 balance is worth over $60,000 by itself. That's before you even count the year she avoided losing $53,000 outright. This is the quiet math of retirement. It's never one dramatic decision. It's one boring percentage point compounding while you're not looking. Now, follow who actually profits when you don't know this. The fund manager charging a fee on your bond fund gets paid whether it goes up or down. The advisor who sold you the 60-40 allocation gets paid on assets managed, not on outcomes delivered. The institutions issuing 30-year bonds get to borrow cheap while you carry the risk of holding that promise for 30 decades. Everyone in that chain gets paid before you find out whether the bet worked. So here's the actual next step, not someday, today. Open your retirement statement and find one number, the duration of your bond holdings. It's on the fact sheet. If it's above 5 and you're within 10 years of retirement, ask your advisor one honest question. Why is my safe money exposed to a 30-year bet I never agreed to make? And here's the honest exception. If you're decades from retirement, if you can stomach volatility, if your bonds are a small sleeve of a much bigger, longer horizon plan, none of this urgency applies to you the same way. This isn't a video telling you to panic. It's a video telling you to actually read the label on the thing you were told not to worry about. Because the people who get hurt by markets like this are never the ones who took a risk on purpose. They're the ones who were told there wasn't one.